Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap for the trades that we made here today on January 9th. As always, with all of our video alerts that we send this out just to our members only at OptionAlpha.com first, and then 5 to 7 days after that we'll post it publicly on YouTube. So if you're watching this now on YouTube or some other channel and not on optionalpha.com, this is a delayed video, so you have to sign up for our membership at optionalpha.com to get these live trading alerts and live video analysis. So I want to go over the opening trades that we had today as well as the one closing trade that we had. If you remember the video from last night, you'll remember that I had a lot of orders that were working, and like I said, finally a lot of these orders started to come into the market and become filled. So I'm going to go over first though, before I get the opening trades, because there's a lot of similarity between the first three, is cover the closing trade that we had on the VIX. Now, we're already playing VIX in a couple different positions this month for January, and they're all really profitable positions. And what we started to do was take off those positions and lock in some profits. So the first trade that we took off here today for VIX was that we bought back the 3 short naked puts that we had for the VIX, and those were the 13 strike. Now, a lot of people get confused. This 14 here actually is a tag for the January options 2014. That's the expiration month, but it's actually the 13 option or the 13 strike puts that we sold. And we sold these for $45, so that brought our break even to around $12.50. And we did this when the VIX was really, really low. And so again, today all we're doing is buying that back in because we do have a short option. We're getting close to expiration, so we made a good chunk of money on this trade, and so we just bought it back. So again, this is where we sold the VIX options at. This is the 26th, right after Christmas, and you can see the VIX was already down into the low 12s, and we actually sold the option strike that was in the money. And for the VIX, this is usually something that's okay to do. I wouldn't suggest that you do this with all of your trading. Obviously, you don't want to sell naked options that are in the money, but with the VIX, the long-term average is around 13, 14 for the VIX. So we felt comfortable selling the option at a 13 strike with our premium that brought our break even down to around 12.50, which is right around here. So at 12.50, it was a very, very comfortable area that we thought, okay, you know what, at some point the VIX is going to trade above this in the next 30 to 40 days. So we feel comfortable selling this option, taking some premium in and letting it decay. Now you'll actually notice with the VIX trade that the VIX actually did move up and then come all the way back down, and yet we're almost at the same level that we are now as far as break-even price, but we've made the vast majority of our profit, and that's because this option has decayed in value over that time period. So again, we just took the trade off and we're moving on to the next trade. So let's talk about the 3 vertical spreads that we also put on here today. There was 2 put spreads and 1 call spread, and these are the ones that we had opening tags for sold. So what that means is that we sold the verticals to open and we took in a credit, which again we designate right here with these credits at the end of each trading alert that goes out. Now the first one was WFN, and we sold the February 55, 57 and a half call spread. So that means that we sold the 55s and bought the 57 and a half calls to help finance that sale. All in all, we took in a credit of $67 per spread. So we sold 2 spreads, again, took in a credit of $67 per spread. So let's take a look at WFM and see why we actually made that trade. Kind of what was the logic behind that. So we'll go to WFM here on our charts. All right, and you can see that Whole Foods has had a really, really tough time over the last couple of months, moving consistently lower and lower after the major gap. But here's the main reason why we entered this vertical credit spread versus any other strategy that we had out there. And that was because implied volatility was very, very high. And it's usually above that 50th percentile that we like implied volatility to be at. Now, right now it's at the 82nd percentile. So it's actually very, very high. Now, another strategy that we could have done is we could have done Iron Condor. We could have done a strangle, a straddle. Those are all good strategies as well. Butterflies, those are all great strategies for this. But in this case, because of the gaps and because we do have earnings that's starting to come up here in the next month or so, we did want to be cognizant of that and just understand that, okay, Whole Foods did gap down last time it had earnings. So the likely direction, if they do miss earnings and they've had a real tough time trying to find any support lately, is that it's going to be moving lower. So rather than doing Iron Condor, which means that we want kind of Whole Foods to trade sideways, butterfly strangles, all that stuff, we want Whole Foods to trade sideways. we're actually just making more of a directional play and selling the 55, 57.5 call spread. So we want Whole Foods to move lower. If not move lower, at least move sideways while volatility contracts. So that's kind of the logic behind that trade. All right, so let's move on to Facebook. Now, Facebook's a trade that actually we've been trying to get into for a couple days now. And implied volatility has been really high on Facebook, which has been great. And we finally got in. We sold two vertical put spreads, the 52.5 and 50 puts. So we sold the 52.5 puts and bought the 50 puts, again, taking in a nice little credit of $67 per spread that we sold. So again, let's go to Facebook, take a look at this, see where it was trading at here today. Again, you'll notice, and it's a little bit hard to see on the chart here, but in yellow up in the top left-hand corner, the implied volatility is at the 67th percentile. So it's above that magic 50th percentile that we look for when selling option spreads. And almost the same thing logically happened with Facebook that happened with Whole Foods, is that we do think that Facebook could continue higher. And again, we have earnings that are coming up right in the middle of our expiration cycle. So consistently, Facebook seems to outperform earnings, at least in the near term, that near-term history. So again, we don't want to kind of sell a call spread and get in front of this moving train, if you will, and have Facebook just run right through our call spread. So instead, what we did is went ahead and did the put spread, which is below the market, 52.5 to 50. So that means it's giving us a lot of room to be wrong. Facebook can drop all the way down to here. As long as it doesn't go below there, we'll still make money on the trade. So this, to me, was a really good trade. We're trading in the direction of the trend, at least for now. Facebook seems to be a hot stock to trade. So we don't want to get in the middle of this train heading up higher. So at least for now, we're trading below the market, giving ourselves room to be right. But the main thing is we're trading the right side of volatility. So at least with Facebook, let's go in and just take a look at, we don't want to take a look at all that stuff. Let's take a look at where the actual strikes are that we entered. So you'll notice here our position on the left-hand side or the right-hand side of the screen is designated by these two tabs here. And you'll see that our strikes were right at almost the 30% level when you factor in the credit that we received. So we received a 67-cent credit, and that brings our break even down to around 52 on the actual profit and loss diagram. Our first strike was 52.5, our second strike was 50, and the 52.5 has a probability of being in the money of about 35. So we just kind of do a little bit of guesswork and say, okay, it's probably around 30% as far as the probability. So this is a 70% probability trade, meaning it's a 70% chance it's going to be a winner. And again, we're trading with the odds in our favor, even more so by trading high implied volatility. We can still trade 30% probability levels during low volatility environments, but that doesn't really help our position. The position that we put on is designated or designed to profit from a decline in volatility. So that's what we want to do by putting on that position at that probability level. All right, so the other one that we had as far as the vertical spreads was CMG, Chipotle, and we sold the 515, 510 put spread. A little bit wider of a put spread, but you can see we're taking in that same amount of credit, about 30% of the width of the strikes, or about 1/3 the width of the strikes. We're taking it as a credit. So Chipotle was a $5 wide spread, the 515 to the 510. We took in $1.50, which is a very, very healthy premium for that type of strategy. Again, the same thing is going on here with Chipotle as in Facebook. This stock continues to move higher and higher and higher. And right now, implied volatility is crazy high in Chipotle. It's just kind of jumped over the past couple of days at 83rd percentile. So what that means is that Chipotle's implied volatility is basically in the top 3/4 of where it is normally during the year. So we obviously want to take advantage of that in trade volatility. Again, let's go to the actual trade tab here of Chipotle. You can take a look at where our positions are. Just about off the chart here for where the strikes are lining up, but you can see our two positions on the right hand side of the screen designated by those little tabs. And again, same thing here with Chipotle as with Facebook, is we sold about the 35-30% options as far as the probability of being in the money or out of the money. So it's given us a lot of room. Chipotle is trading at 551, closed at 551 today. So our strike at 515, our first strike there, is a good distance away. So we've got a lot of movement in Chipotle. We've got a lot of room for Chipotle to run down to 515 and us to be okay. So I like that with trading that you can, at least with these option strategies, give yourself enough time to be right, but also give yourself a little bit of flexibility to be wrong, okay? So let's go into the last trade here today, and that was just a pure vertical call spread on EEM. Now this is a little bit different than the two trades that we made above. This is just purely a directional trade during low volatility. So I get a lot of questions from people saying, hey Kirk, what are some strategies that you can use in low volatility environments? And this is exactly one of those, just directional trades on the market. And so on EEM, what we did is we bought the 39 calls and sold the 40s to help finance the purchase of the 39s. And so in this case, our strike width is about $1, and we always want to pay about mid price. So we always want to pay about half the width of the strike. So $1 wide strike in our spread, we want to pay about 50 cents. In this case, we paid a little bit over that, a little bit of a premium, but that's okay. We paid about 55 cents on this spread. So let's go to EEM and decide why we kind of went towards the call side versus the put side. And again, this is nothing more than just making a directional assumption on the market. I have no idea where EEM is going to trade. I don't look at a lot of technicals on this, but what I do know is that the past 6 or 7 days here, we've had a lot of downside movement in EEM. So with implied volatility just at the 37th percentile, it's not above that magic 50th percentile that we look for when selling option premium. So with implied volatility low, we only have really kind of two choices here, and that's to take on some sort of calendarized trade or to trade this thing directionally and hope that we possibly also get a move up in implied volatility. So what we did here is we just traded the directional trade here, the 39.40. So as long as EEM basically trades anywhere above where it's trading now, by expiration, we have an opportunity to take a profit. And so that's a bet that I will take pretty much any day of the week, is just making this directional trade on the market that at some time between now and February expiration, so we've got a lot of time, and you can see where our kind of horizon is. We just want EEM to trade above this level and give us an opportunity to take a profit. Now it can trade below here the whole time, all the way, and then just at the last moment trade above it. We'll still have that opportunity to take a profit. So basically all I'm betting on here is that if EEM trades above this level, anytime between now and expiration, we're going to close the trade early, take money off the table. Right now, this is a purely 50-50 probability trade. There's a 50% chance it's lower, a 50% chance it's higher than where it is right now. That's all it is. Nobody else knows any different. You don't know any different. I don't know any different. So we're just making a directional assumption trade on the market. So again, hopefully you guys enjoy these videos. As always, please add your comments below to the comment section here for members. I'll get back to your guys' comments.